On February 28, Israel and the US launched a joint military operation against Iran. And in the attack, Supreme Leader Ayatollah Ali Khamenei was killed in his compound in Tehran. Not only that, Israel says that its strikes also took out 7 senior defense and intelligence officials and targeted 30 top military and civilian leaders. This wasn't just an assassination, this was a full decapitation of Iran's leadership. Iran retaliated almost immediately, launching missiles and drones at Israel and US military bases across the Gulf in the UAE, Qatar, Bahrain, and Kuwait. Then things escalated further. Iran's Navy broadcast on emergency radio channels that the Strait of Hormuz was banned to all commercial traffic. As a result, about 150 ships, including oil tankers, were stored at sea. And there were also attacks on commercial ships, where a tanker was hit in the Strait of Hormuz. Because of all this hoo-ha, as of Monday morning, oil is already up 12%. Gold has surged above $5,296 per ounce, and S&P 500 futures are down by 0.5%. In this video, I'm going to break down why this attack happened, what the historical data says about your investments during times like this, what could happen next, and what I'm personally doing with my portfolio. But first, to understand what might happen next, we need to understand why this attack happened in the first place. Now, this attack didn't come out of nowhere. It had been brewing in the background for years. According to the US and Israel, the main reason was Iran's nuclear program. Iran had been enriching uranium to 60% purity, which is far beyond the 3.67% limit set by the 2015 nuclear deal that Trump pulled out of back in 2018. On top of that, the IAEA, which is the UN's nuclear watchdog, also found hidden stockpiles of highly enriched uranium in an undisclosed underground facility. In other words, Iran had been concealing nuclear progress even from the inspectors who were supposed to be monitoring them. Because of all this, the US presented Iran with 3 core demands: permanently end all uranium enrichment, accept strict limits on ballistic missiles, and completely halt supports for proxy groups like Hamas and Hezbollah. And as you might expect, Iran rejected all 3. Then came the diplomacy. On February 19, Trump held the inaugural meeting of his Board of Peace at the US Institute of Peace, where he gave Iran a 10-day ultimatum to make a deal or face consequences. A week later, on February 26, the US and Iran held a third round of indirect talks in Geneva. The talks ended without a deal, but both sides had actually identified the main elements of a potential agreement and planned a follow-up technical discussions in Vienna. However, the follow-up talks never happened. Just 2 days later, Operation Epic Fury was launched, and the guy who created the Board of Peace turned it into the Board of Peace. The White House released an 8-minute video statement where he made it very clear that the goal was not just to destroy Iran's nuclear program, the goal was regime change. And the timing wasn't a coincidence either. Iran was at its weakest point in decades. Their economy was in crisis with inflation above 40%. There were nationwide protests in January 2026, and their military was still degraded from the June 2025 war with Israel. It was a strategic window that wouldn't stay open forever. So, does this mean that the market will boom when it opens? To answer that, we can look at some geopolitical events that has happened in the past and how they have affected the S&P 500. But before that, speaking of investing through uncertainty, it has been over 1 year since I started doing weekly dollar cost averaging through the Moomoo regular savings plan. And so far, I'm up by about 10%. What I like about Moomoo is how easy it is to discover and research investments. For example, you can head over to the Markets tab, go into US, then ETFs, and you'll be able to browse through different ETFs and analyze them directly within the app. You can also compare between ETFs to see what are the differences between their performance, holdings, and so on. Once you have decided what you want to invest in, you can just open it, tap on the 3 dots at the bottom right, and select RSP. You can set your investment, amount, and frequency, and even choose to debit funds directly from your bank account, so that everything runs automatically. New users who sign up to Moomoo SG will get to earn up to $1,864 worth of welcome rewards when you fulfill the terms and conditions, which includes a $100 worth of Nvidia shares exclusively for my channel. Also, Moomoo is running a limited time Huat Anbao during the Chinese New Year period for both existing and new users. And you have a chance to get up to $888. Plus enjoy zero commission for US, Hong Kong and Singapore stock trading. Simply follow the steps here and key in my promo code to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. On day 1, the median return is only negative 0.1% and is positive 50% of the time, which is basically a coin flip. This is really surprising when you consider that these events aren't minor events. We are talking about full-scale invasions, oil embargoes, and the assassination of a top military commander. And yet, on average, the market barely moves on day 1. And here's where it gets even more interesting. By the first week, the market is already positive 64% of the time, with a median of positive 0.6%. By 6 months, it is also positive 64% of the time, with a median of 4.9%. And at 12 months, the S&P 500 is positive 77% of the time, with a median return of 13.6%. In fact, there were only 3 times where the S&P 500 was still negative at 12 months. The first was the 1973 Arab oil embargo, where the market dropped by 35.4%. But that wasn't just a war. OPEC cut off oil supply to the entire Western world. Prices quadrupled from $2.90 to $11.65 per barrel, and the global economy went into full stagflation. The second was 9/11, where the market was down 20% at 12 months. But 9/11 happened right in the middle of the dot-com recession. The market was already falling before the attacks. And the third was the Russian-Ukraine war in 2022, where the market was down by 6% after a year. But again, that coincided with global inflation hitting 40-year highs and central banks aggressively hiking interest rates. What this tells us is that geopolitical events by themselves don't cause prolonged market crashes. The only times they did was when the event hit during or triggered a broader economic crisis. So the question here isn't so much whether is there a war, but rather the real question is, will this war cause something bigger, like a sustained oil crisis or a global inflation? And that brings us to the single biggest risk factor right now. If there's one thing that could turn this from a temporary market dip into a real economic problem, it is the Strait of Hormuz. For those who do not know, the Strait of Hormuz is a narrow waterway between Iran and Oman. About 20 million barrels of oil pass through it every single day. That's roughly 31% of all seaborne crude oil in the world, and about 20% of global LNG exports. Or to put it simply, if the strait shuts down, the world's spare oil capacity would get locked in. You simply can't just reroute that oil, as there's simply no alternative route for most of it. And sure enough, Iran declared the strait closed on February 28, and that has caused about 150 ships to be stopped, with the traffic dropping by 75%. Now, Iran has been threatening to close the straits for decades, but here's the thing, they have never actually fully closed it. Not even during the Iran-Iraq tanker war from 1984 to 1988, when Iran was actively attacking commercial ships in the strait for 4 years straight. Even then, oil still flowed, and oil prices actually declined over that period. And what's happening right now is following a similar pattern. Within 24 hours, Iran walked it back, and Iranian general announced that the strait was open again, though he warned that US warships could still be attacked. So why didn't Iran keep the strait closed? A few reasons. First, the US is actively destroying Iran's navy. 9 warships have already been sunk. Iran simply doesn't have the naval power to sustain a blockade against the US fleet. Second, and this one is really important, OPEC just agreed to raise oil production by 260,000 barrels per day despite the war. They are not cutting supply, they are not showing solidarity with Iran. So if the oil producers themselves, the people with the best information about supply risk, are increasing the output, that tells you something. And third, Iran itself only produces about 4% of global oil supply. Compare that to the 1973 oil embargo, where the entire OPEC cartel coordinated an embargo together. That was multiple countries acting in unison. But today, Iran is just one country acting alone with a weakened military against the world's largest navy. Now, that doesn't mean the risk is zero. Even a partial disruption has consequences. For example, oil analyst Andy Lippo projects a 7% or more increase in oil prices depending on how far this escalates. Barclays is even more aggressive, raising their oil price forecast from $80 to $100 per barrel overnight after the strikes. If that happens, then things could get ugly fast. For example, in 1973, oil prices quadrupled by over 300%, and US inflation surged from 3.4% to 12.3%. Then in 1979, after the Iranian Revolution, oil more than doubled and US inflation hit 14.8%. And most recently in 2022, when Russia invaded Ukraine, oil surged over 50% and US inflation hit 9.1%, the highest in 40 years. In all three cases, central banks were forced to aggressively hike interest rates, and that's the scenario where things could start looking really bad for the markets. Thankfully, while oil has gone up by 12% so far, it is still at $75. That's nowhere near the $100 level where things start to break. The Strait is technically open, OPEC is raising output, and the US is systematically destroying Iran's ability to keep the Strait disrupted. So which way will this go? That brings us to the two possible scenarios. Scenario 1. The US has estimated that the entire operation would take about 4 weeks. But so far, things seem to be progressing faster than expected. The Supreme Leader is already dead, 7 senior defense and intelligence officials have been taken out, Iran's navy is being destroyed, and the Strait of Hormuz, which was the biggest risk, was reopened within 24 hours. If things continue at this pace, oil might even eventually settle back to the $75 to $80 range. If that's the case, this becomes yet another Soleimani 2020, a scare that passes and the people who panic so end up missing the recovery. Then comes scenario 2. This is where this operation turns into yet another drawn-out military campaign. In this scenario, the Strait of Hormuz gets disrupted again, oil pushes above $100 and suddenly you are looking at a very different picture. Higher oil means higher inflation means central banks pausing or even reversing rate cuts. And as we have just saw from the historical data, that's the exact combination that caused the three worst outcomes. On top of that, Iran's proxy network could also widen this conflict. Hezbollah in Lebanon, Houthis in Yemen, militias in Iraq. If those groups escalate their attacks on shipping lanes or US bases, the market uncertainty would get a lot worse. So which scenario is more likely? Right now, the signals lean towards scenario 1. OPEC is raising output, not cutting it. Iran has already walked back the Strait closure within 24 hours, and even crypto, which typically reacts faster than traditional markets, has already started recovering, which suggests that traders are betting on a shorter conflict. However, all this is still a big if, because the one thing that makes this different from past conflicts is the regime change agenda. This isn't just a targeted strike like Soleimani, where you take out one guy and go home. This is an attempt to topple the government. And if anything, history tells us that toppling governments typically takes a lot longer than destroying military targets. For example, the US spent 8 years in Iraq after Saddam, and over 20 years in Afghanistan after the Taliban. So even if the military campaign here wraps up in weeks, the political aftermath can drag on for years. Now, does that mean the global economy is in trouble? Not necessarily. Even though Iraq and Afghanistan were in long wars, they didn't cause global recessions on their own. On top of that, the key difference is that neither Iraq nor Afghanistan sits next to the world's most important oil choke point. So the risk isn't really about the war itself, but rather it's about whether the war keeps oil elevated long enough to trigger the kind of inflation spiral that we saw in 1973, 1979 and 2022. So after looking at all of this, what am I personally doing? Honestly, nothing. The historical data is pretty clear. In 77% of cases, the S&P 500 was positive 12 months after a major geopolitical event, with a median return of 13.6%. The only times it wasn't were when the event triggered a broader economic crisis. And right now, we are not there yet. So for me, the plan is simple. I'm not selling anything. I'm not panic buying defense stocks, oil stocks, or commodities. I'm sticking with my regular investment schedule and dollar cost averaging as usual. That said, I'm not ignoring the risk either. There are a few things I'm watching closely. First, oil prices. If oil stays below $80 to $85, I think we are fine. If it starts pushing toward $100 and stays there, that's when I will start getting more cautious, because that's when it might start feeding into inflation. Second, the Strait of Hormuz. If traffic goes back to normal in the next few weeks, that's a strong signal that scenario 1 is playing out. But if there are more tanker attacks or another closure attempt, that changes the picture. And third, whether OPEC changes course. Right now, they are raising output, which is bullish. If they suddenly start cutting, that will be a huge red flag. The bottom line is this. If you have a long-term investment horizon, history says that the worst thing that you can do right now is panic sell. While that doesn't mean that nothing bad can happen, it does mean that the odds are in your favor if you stay the course. But what do you think? Are you holding, buying the dip, or moving to cash? drop a comment down below. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.